Gold went from the most loved to now one of the most unloved areas. And what my fear is that it could rally and then fall even harder. That's my concern.
Yeah, and for us, nothing's permanent. The only permanent part of our portfolio is to manage risk.
Welcome to Trends with Friends with Invest with Rules. I'm Scott Bennett with the great Mike Olafson. It's June 25th. We have some really interesting topics from a member, Jim. So he shared more about the momentum ETFs. We'll cover the market. There's been certainly a little bit more volatility. I feel like every show that we do once a week, Mike, the market has more volatility on when we schedule this call. Is that pretty fair, Mike?
I think it's very fair. Yeah,
Yeah.
we're moving the market, Scott.
Yeah, right. All right, let me share some screens here. And can you see that?
Yep.
Welcome to Trends with Friends. We're so grateful that you're here. Thank you for being a member. Before we dive in, world's quickest disclosure, this is just information, not a direct solicitation to go buy or sell anything. Please always manage your financial process, your plan, your risk, your rules. There's risk out there. It's been a really fun year. We've had a strong year, but there's always underlying risk that will rear its head. This, again, if you have questions, this is the perfect platform to do it. We follow the trend, we follow big money, we follow risk management rules. You'll see us do that on a live sheet in the members area. Thank you for being a part of our community. If you have questions beyond today's call, hello at investwithrules.com. We'll do our best to get back to you as timely as possible. If you're like, this is awesome, but I'm maybe not doing as well as I'd like, or I'm not clicking the buttons, I'm not managing risk, we have a totally separate entity called IWR Advisors, Invest with Rules Advisors. If you have questions, there's never any pressure whatsoever. But if we can be helpful, we care about you and want you to do well. So, Mike, we're going to start off with a topic called momentum ETF. So we have this all these new rules going into the S&P 500 and the total market index, and you're going to get SpaceX, which not shockingly on IPO day we had Kathy Donnelly talk about how be careful, wait 6 months. And lo and behold, you were below the IPO price pretty quickly. I haven't looked at it in a day or so, but we can look at that later. But you're going to get SpaceX in there. You're going to get Anthropic in there. You're going to get OpenAI in the S&P 500 at some point, and they're not profitable companies. And at some point, they're going to water down the future returns of the S&P 500. So how do you deal with all this fun stuff? Mike, why don't you take over the good, the bad, the risk of momentum ETFs?
Absolutely, Scott. Yeah, and Jim, thanks again for bringing this up to us. And we thought it was a great topic to jump on, so thank you very much. But yeah, I think as most of you know, the ETF world over the last several years has exploded. There are ETFs for so many different things. You want to short Microsoft, you want to triple leverage the Qs, whatever. There's an ETF for it. And one of the parts, the subsets of the ETF market that we really like is the momentum ETFs. And by the way, just to level set, an ETF, it's simply a basket of stocks or holdings assets. In the case of, say, a commodities ETF, it's going to be a basket of assets. And it's simply like a mutual fund, except it trades every single trading day on the minute, on the hour. So that's an ETF. Momentum ETFs, they're basically ETFs that are based on an underlying index. And we'll take a look at five of them in a minute here. So let's take the S&P 500. There's the S&P 500, 500 stocks, and then there's the momentum version, which is a subset of that. And it's basically a concentration on the strongest members of the underlying index over a certain period of time. So it's basically trying to grab the strength and concentrate the ETF in that strength. How they do it? They typically hold the top 20% best performers in the index over the last, let's call it 3 to 6 months. Sometimes as long as six, sometimes as short as three. And I'm sure there are others out there doing all kinds of variations. And then this reshuffling takes place, on a certain, and we'll talk about that in a minute, but on a certain basis. So you kind of have to be somewhat aware of the reshuffling dates. But why do they do this? The goal is to achieve alpha beyond by holding relative strength so you could theoretically beat the market. That's the goal. The goal is that, okay, the index is doing X. It's at, let's call it the S&P 500 beta of 1. And the goal here is by holding the momentum, the strongest parts of that index, you're creating some outperformance, some alpha. And basically, the thesis is, and I love these three words: strength begets strength. Does it always happen? Is it always perfect? No. But generally in the market, momentum basically equals that strength continuing. Momentum continues until a catalyst stops it. So let's go to the next slide, Scott.
Yeah, so just in context,
Yeah.
so like if one owns XLK, the Spider Tech, it's pretty much Nvidia, Apple, Microsoft. But what if one of the three, which are like they're really heavily weighted in some cases, what if one of those three is really underperforming over 6 months, a year, 2 years? Then it could say we don't want to own Microsoft, or we wanted to own Palantir, but we don't want to own it now. So that's kind of the beauty of some of these tickers. But let's look at a few specifically.
Yeah, so here are five major indexes and momentum versions of the index. And we'll start at the top with the S&P 500, which I've already mentioned. And the momentum version is SPMO. The top five holdings. Now, of course, the holdings get adjusted. This may be a little bit old, but the holdings include Nvidia, J&J, Broadcom, Micron, Google. So no big surprises there. The strength of the S&P 500 is in SPMO. It's reconstituted or reshuffled every March and September. The beta is about a 1.1. So if the market is a 1, S&P 500 is a 1, this is moving about 1.1. And I'll be honest with you, I was a little bit surprised when we looked up these betas that the beta wasn't a little bit greater considering the outperformance and volatility, but it is what it is, 1.1. And then the last two columns show the momentum 5-year return. So in other words, if you bought SPMO 5 years ago, here's the return. The aggregate return would have been 185%. And then how does that perform versus the index? And it's got an outperformance of 100%. So in other words, the S&P 500 is, let's use round numbers, 85%, and the momentum version is 185%. Sounds great, right? But it's not always such a rosy picture. So as we work down the sheet, we look at the mid caps. MDY is the index or the ETF index, and the momentum version is XMMO. You might recognize some of the holdings because I think at least two of these are in our $1 billion fund manager listing this month, ATI and WWD. This also reconstitutes every 6 months. You can see the beta, you can see the outperformance. So this has got about a 60% outperformance over the index. So in other words, the momentum version beat the mid cap index ETF by about 60% over 5 years. Then we go to small cap, we run through the same thing, and we end up with an outperformance of about 37%. Then the fourth one, we look at international, and we come along. And by the way, no surprise, don't recognize a couple of the top five holdings because they're international companies outside the US. So no big surprise there. And the outperformance here over 5 years has been about, let's call it 10%. So definitely less than, say, the others we've looked at. And then we get to the NASDAQ 100, which is represented by the Qs. Everybody knows the Qs. That's the 100 top stocks of the NASDAQ. And then the QQQA takes those and reduces it down even further to the top about 20. And the top holdings include ARM, Marvell, AMD, Intel, our winner STX. In Here's a key thing: it's reshuffled quarterly, every January, April, June, and October. The only one of these five that does it quarterly, not semi-annually, meaning every 6 months. The beta, no big surprise. This is higher, 1.32. But then you look at the 5-year return, not too shabby, but it underperforms the underlying ETF QQQ by about 17%. Why is that? Well, I've got some theories on that, and Scott, I would like to hear your theories. But part of the theory, I think, as to why the Q's version has been underperforming over the last several years is because of that reconstitution, that reshuffling every 3 months. Now, I could be wrong on this. This is just my kind of gut check here, but I think that it's kind of almost rotating the deck too often, and it's likely churning the holdings too often, which is leading to some underperformance. Could be wrong there. Scott, what's your thought on that?
That particular ETF came out at the end of 21, so at the peak right before the 2022 mess. And
Yep.
I think the reality is 2022 was horrifically awful for this ETF, which destroyed its 5-year return. So it was a high of 47 and a low of 28. So it got a haircut. And I think longer term data will likely prove more friendly to this. But again, these aren't recommendations for you to go buy all these. We take these tickers in our ETF rank, and then we want to only own them when they're in short-term uptrends, short-term and long-term uptrends. When these particular tickers are in short-term downtrends, they are very, very dangerous, specifically QQQA. So that's why we are always managing risk very tightly, but these have the ability to outperform, and that's what we're trying to accomplish in strong uptrends.
Yeah. And just, before we move on to look at the five charts of these five momentum ETFs, just to add to what you said, Scott, when the last couple of V-shaped recoveries, we've gone into SPMO versus SPY, not because, oh, we want to go into SPMO, but because SPMO came out of and started recovering quicker than SPY. So the signal was there sooner, and that's why we end up in SPMO versus SPY. That's the reason, not because we preferred it.
Yeah, it's a who comes out of the gate quicker, who has
Mhm.
relative strength.
Exactly. All right, let's look at really quickly look at five charts. This is the trading view chart that many of you are getting to know and love. And the only distinction here is the actual chart itself is of SPY in this case. The blue comparison line that you see kind of coursing through the chart, that's the comparison to SPMO to show you that performance. But to Scott's point, look at it for the first couple of years. You'll see it was kind of bouncing around with the index, and then outperformance came as the market really kicked it and started kicking into this latest bull run.
And this is a monthly chart for grins, just so everyone knows. This is a monthly chart of the S&P 500. The blue line is SPMO, and it's significant outperformance starting in really after the 2022 mess.
Yep. And then we take a look at the mid caps, same type of story. And then we can go to, I believe, small caps. Small caps, you could see kind of similar kind of story. Yep. And then let's take a look at international. So a little bit closer. As you remember, the outperformance is about 10%, but you can see how similar story, but the outperformance hasn't been, tremendously greater, but certainly better. And then lastly, we'll look at the Qs. And you can kind of see what Scott was talking about, but literally the catch up is just happening in this year. And with I think the AI play, et cetera, that's been creating that catch up you see at the recent end of the chart.
All right. Well, this is a pretty sweet topic. Thanks for covering this, Mike. I think it's really, really interesting as active, or I would say hybrid between passive and active is becoming more and more popular. These ETFs are a behemoth of trillions of dollars now, where mutual funds are bleeding. And these rotations are really important to all of our success. What's the final summary?
Yeah, so the final summary is that there are a lot of advantages to momentum ETFs. They align with our trend following methodology, takes the emotion out of it. Basically, the ETF is making the decision as far as where the strength is and doing the rotation. You got potential outperformance like we talked about. Diversification, maybe not quite as much as the underlying index, but you certainly do have more diversification than, say, putting all your money in, say, in NVIDIA or Micron, and you do gradually rotate into leading sectors. Now, the risks, so the downside is no inherent risk management. And this kind of ties back into what Scott said. that we are diehard believers that say you really do like the momentum ETFs and you decide to use them, that's up to you based on your tolerance. But the key is we really believe there should be some type of risk management because there is none inherent in these ETFs except once every 3 to 6 months, taking the dogs and moving them out. And that, in our opinion, is not really diehard risk management. They can, like we talked about, they can underperform. There is sometimes sector over diversification, like the current AI trade, and you might miss those emerging leaders due to the time lag of the reshuffling. So overall, we just wanted to present this to you. Jim, thanks again for bringing this up. We thought it was a great topic. We do like these ETFs because they kind of align with our mindset. But just like everything in the market, nothing is ever perfect, and you have to watch your risk.
Well done, Michael. Before we transition into portfolio performance, any questions in the queue about this interesting topic?
Yeah, great, great. Yeah, let's take a look at that.
Isn't that fun? I have you present this topic and then handle the queue. You're the best.
Yeah, and you know how well I multitask. So, uh, let's see. Anne asked, "What is the trading volume liquidity for these momentum ETFs?" Great question. It's typically pretty decent, Anne. So, you could take any charting service and take a look. TradingView will show you. But typically, we have yet to see a liquidity issue. And I think, as y'all know, in our advisory, we are placing pretty darn large trades. And so we look at liquidity because of that. And we have yet to find a problem with any of the momentum ETFs, especially the five we presented to you. But please do your own due diligence just to be safe.
And if you really are having some sweet downtime later this week, if you want to Google or AI creation redemption process around how ETFs handle flow, they're not like a penny stock where you can really mess with the price significantly because they have the ability to create shares on demand and then flow them into the system kind of seamlessly. So if you're uncomfortable, then there are limit orders. There's different order types you can talk to your brokerage company about. We have a little bit more tricks up our sleeve in our advisory group, just because if we're trading a larger ticket order. But I would say that it's always worthy of doing your due diligence.
Yep, absolutely. And then following the same line, Greg asks, when is the best time to enter a momentum ETF at the reconstitution? I'll give Scott. I've got an opinion on this. You want to give yours first, and I'll tag on.
You go first.
Yeah, my opinion, Greg, is that follow the price action. In our case, follow the signals or whatever process you follow. So the reconstitution, and frankly, that's a great deeper dive to do at some point to actually look at how the reconstitution dates affect the actual ETFs. We did not do that for this analysis. We kind of kept it kind of high level. But my feeling is just like this latest V-shaped recovery coming out of the Iran war, and SPMO was first out of the gate versus SPY. That to us was the ideal time that if you're going to do it to go ahead and enter in on the confirmed gas signal, managing risk all the way. So just in case it didn't work and the market turned, boom, you manage your risk and get out. So my bottom line answer, Greg, is price action. Scott, what say you?
Yeah, yeah, gas signal.
Yep.
Um, correct. Yeah, I would go gas signal.
Yep. Okay, excellent. And then Jim says 5-year performance of QQQA loses to QQQ. 4-year performance, they're even. 3 years or less, QQQA beats QQQ. Yeah, absolutely, Jim. And I think you can see on the chart. And I think part of that is just been such the chip play, the AI play, and the fact that you're taking the sweet spot of the Nasdaq 100. And yeah, there you go. But the key is that we don't know if it's going to do that going forward. None of us know what the market's going to do going forward, and that's why we always emphasize to manage your risk because we don't know that QQQA is going to keep beating the Qs.
All right, well done.
Excellent.
So what we're going to pivot to, let me
Oh,
just
Wait a second. Wait a second. This is a good one.
Yeah.
Jason said asks, when is the IWR ETF coming out?
In,
Go ahead. You tackle that one, Scott.
Yeah, it's a fair and fun question because we have a bunch of strategies up our sleeve, but we're really happy with the ones that we have here. We share with you a trend roadmap. We have the same research as in Fastlane. It's just slightly kind of tweaked a little bit. But ETFs are a funny business where there's a lot more oversight and compliance around brokerage ability. So, like, imagine we have an ETF and we can't talk about it on this show. So, um, hedge fund ETF, I think we're still always kind of open-minded, but we totally understand where the need of more of these kind of dynamically active ones are out there. But I think the hardest part is that we're human and we're probably going to sell a great thing at the wrong time. So our starting position beyond the newsletter was we want trend following strategies where we can partner with you and help you make good decisions as a fiduciary, and then also financial planning. So that's why we started with the RIA, and technically it's super regulated. You don't have to have on day one 25 to 50 million, and you don't have to play by all these different brokerage house rules. And it's a really interesting world where if you're the behemoth like iShares or Vanguard or the biggies, they own the space. So you have to create something unique at this point because everything else is pretty much covered. Anything you'd add, Mike?
Yeah, ironically, and Jim, thanks for pointing this out. There's already an IWR ETF, and guess what? It's another mid cap ETF, Russell mid caps. So there you go, ironically.
We need a new
So,
ticker. Okay.
so we need a new ticker, Scott, if we ever did this.
Yeah, this is from this morning. It was even brighter this morning, but that's life. Market kind of did a huge gap up and a fade, which is part of the reality of rotations. So Micron had really strong earnings. The inflation numbers were pretty ugly, but we all know that the oil prices are falling, so likely inflation's not as horrible moving forward on the dot plot. So our performance year to date, again, we track this pretty closely. We know people care, but we're not always taking the same level of risk as the S&P 500, and that's why we peg ourselves over time and over years to more of a 60/40 type model. And that's why our fast lane strategy, which is kind of what we're doing here, but just billion-dollar fund manager stocks, that's more like the S&P. So overall, having a strong year, managing risk is paramount. We are still in the left-hand lane. We are not bashful about moving to the middle lane if the signals tell us to do so. But the market is very, very resilient because of earnings. Inflation's coming down. Could there be a pullback at some point? The stock market score is kind of saying there's a possibility. We went from a 10 to a 9. We'll look at the market health in a minute. But Mike, what stands out to you on the Thursday early edition weekly market wrap?
Yeah, and this is from an hour and a half ago, and I'll kind of give some quick commentary with the latest and greatest that I'm looking at. But as you can see, starting on the left-hand side, we'll look at that kind of middle chart and look at how the various asset classes are doing. The S&P 500 so far this week, not having a great week. Year to date, about 8.2%. And it's just slightly, as we speak, down a little bit more. VEU down a little bit more, but having not a great week either. Year to date, still pretty darn solid. PDBC down this week and it's got a lot of oil in it. So as Scott talked about, no big surprises, down 3.6. Year to date, still very strong. Gold continues to kind of precious metals in general continue to get kind of smacked around, having a pretty poor week and year to date down almost 7%. Bonds, surprisingly, and Scott, not to you because you're Mr. Macro, but are having a pretty solid week and now positive year to date. I bet it's just it continues to get pummeled every time it tries to. It's like that game at the carnival where the heads pop up, and every time
Whack-a-mole.
it tries to, yeah, there you go, yeah, whack-a-mole. and it's just getting trounced. Awful week, awful year to date, trailing 12 months awful. And I looked at it yesterday, and I'm pretty sure somebody gut checked me, but I think it's now at early 2024 lows, which goes back a couple of years, if I remember correctly. So not a great story there. We are down a wee bit for the week. In fact, as we speak, instead of point 0.4, we're at point 0.7, down point 0.7. So still better than the market, thank goodness. Year to date at 16% on the dot. And our percent invested right now is at 97%. Portfolio heat is at, as we speak, 4.6%. So a little bit better than we show here. And portfolio heat, for those that are relatively new, it's simply if all of our stop losses got hit over the next day or two, that's the estimate of what kind of drawdown or decrease our portfolio would take, or let's call it 5%. And then the bottom chart just simply shows the performance that we've been tracking since 2022. So it's called 4.5 years now. And it just shows you aggregate performance in the top line, the largest drawdown for each of the asset classes in the next line. And then to us, the all important reward risk ratio. So basically taking the two, here's the reward you get, here's the risk you take. And what is that simple ratio? And the SPY is at 2.2. We are at 5.9. The king continues to be gold at 6.8, even though it's starting to have a kind of a nasty year. Over the last 4.5 years, it's still done the best out of all these asset classes, but on a break signal. Scott, anything you'd add to all of this?
I would add that for anyone listening to know what your portfolio heat is, because it will keep you sane during a bad market. Because the question that always came up when I worked at a very large institution for almost 20 years is how bad is it going to get? Having that number lets you really sleep at night versus thinking it's going to get horrible in your head, and then you start going down a really dark alley where you're like, oh my gosh, like how is this gonna affect me? And then you putting a percentage to that, um, it puts it into context versus the unknown is terrifying. So
And hey, Scott, if you don't mind, go back one. I do want to address the question that Hay asked before we actually started recording here, which is the market score. So the market score is a calculation. It's a relatively simple one that we made up we didn't make it up. That sounds awful. We mathematically derive from looking at the short-term and long-term trends of four major indexes: the S&P 500, the NASDAQ, the international market ex-US, and small caps. And that mathematical equation comes up with the market score. The one question I think where Hay is coming from is, why is it a 9 today and close it at 10 yesterday? This just comes down to sometimes data flow is a pesky thing. And we rely on three different data sources for our stock market data. And the one that feeds our market score was actually hung up. And really, the market would have been theoretically even closed at a 9 yesterday based on my looking at it. And it's at a 9 today. So the key to us, though, we look at the trend, just like everything, we're looking at the trend of the score. Last week, the market score is a 10, and now it's at a 9, kind of showing potential cracks. And we'll talk more about that. Scott, anything to add?
our overall goal is we're going to deploy capital here, short-term, long-term uptrends on a gas signal. We're going to manage risk right here on a coast signal in this strategy. And there are times where if anything gets closer to a break signal, we're out of there. We don't want to have happen what's happening to Bitcoin. That can happen to any one of your tickers over the next few years. So having a process to manage risk is really, really important. We're gonna wrap up our segment, and we'd love to open it up, and we'll look at tons of charts with you. But the market health, our beta is falling. Our stock market score, we'll look at those charts. But this morning, where is the strength still? The rotations are clear. And that's why we've made some moves is it's financials. We own large cap banks. We own regional banks. That's where the strength is. It's industrials. It's healthcare. This is a bigger rotation. And what has been pulling to hard to the left? Tech and the S&P. So that is how the sectors are looking. The sectors that are lagging are still lagging, And then what's off to the far right? You have JP Morgan. They did another stress test. For so far, so good for them. They're on an overheat. Micron came out with solid earnings. Eli Lilly is a holding for us, $1 billion fund manager stock. Warren Buffett's retired stock is showing some life, AMD. And look at this sea of yellow and red in regards to tech, semiconductors, discretionary, and for some reason, expensive staples, which is Walmart. Anything else stand out to you, Mike? And we'll move to the charts.
Yeah, the Magnificent Seven is losing some of its luster, clearly.
Yeah, I would completely say that the rotation is not to the Mag 7. We did, I'll share some charts here. We did let go of things like Amazon. Great company, deliver stuff to my front door all the time. That's not pretty. And we let go of Google. Love Google. Don't love the chart. And even something like SpaceX, UFO. This is why we follow our process. That's not fun. Look at that chart. I mean, we were long gone and we had a really nice profit on UFO. Let's just do the S&P. We'll go through, these are my annotations in purple. If you're new, the dashed green line is the 21 EMA. The red dash line is the 50-day SMA, which the market is hanging on by a thread. The black dash line is the 200-day simple moving average. We are still on a gas signal with a red negative. So here's not great is the Qs are on a coast. That's not great, but you're showing some life. You're above the 50-day simple. That brings us to small caps. That looks great.
Yeah.
Um, that's definitely not holding you back. That's holding you up. I would say the Nasdaq is the reason we're in the nine department. And then here's international above the 21 EMA, kind of dealing with it likely has some gaps and some dividends, but the Qs, the Mag 7 are your problem.
But yeah, let's take a look. We got a few tickers to look at. Let's tell you what, start with J's MUFG.
So MUFG. So you're on a gas signal, which is great. This is likely done really well. I think it's one of the top holdings of the Japan ETF. The only thing I really don't love is that it does have a negative red arrow on it. So that's my only concern. So if one is in this, this is still likely a hold. And I would say maybe get a little bit concerned if you fall below this bar, which would be 1961, would be like a hey alert that something is kind of broken here. But um, let me draw one more fun line. It's kind of interesting how it almost perfectly held support back in February. And here's your cup, and here's your handle, and here's your breakout. So far, to me, this looks like a breakout and a test to support, and it may fall off the red arrow at some point if it keeps climbing. So for me, that's a cautious hold. I wouldn't add today.
Yep. Excellent. All right. Next up, we have got Alex with AHR.
American Healthcare REIT. Now, REITs are interest rate sensitive. The yields are going down. The price of bonds are going up. And you are on a gas signal on a upward green arrow positive momentum. So I don't know a thing about the American Healthcare REIT. Does it hold hospitals or long-term care facilities? I haven't the slightest idea. I don't know if anyone else knows, but I would say this looks very constructive, and as long as one manages risk, I would say a very nice orderly test to the 200-day simple, a little undercut. I think it goes higher.
Okay. Excellent. All right, then LII.
Linux, another really nice gas signal with positive momentum. Um, is the bear market. So there's your bullish to bearish reversal. and now you're getting a bearish to a bullish reversal. And it tried to break up out of the 200-day. This is your third attempt. And I don't know where to draw this trend line, to be honest, because of this strange gap
Sure.
up.
Yeah.
Um, I don't even know if the trend lines are worthy, but I would say this is interesting. This is attractive. It could come back down and test support and then make another run, as it's been pretty sloppy. I would say, again, manage your own system, but I would say small long, and you're getting caught in this congestion is why you had a high and then pulled in. And I think it kind of consolidates and then makes another rip higher is my expectation.
Yeah. And my guess, without knowing anything about the company, is that they probably have not been heavily participating in the AI infrastructure play and then just kind of started to get into it, and which is causing a price catalyst. But I could be so wrong there. So,
But I would
Alex,
say industrials are doing well. On
yeah,
our watch list this morning were a bunch of industrials. I thought I saw like train,
yeah,
like
which
so
is a
it's
competitor. Yeah,
yeah,
exactly.
so it's like heating, air cooling, that whole world.
But like Fix, put up Fix Comfort Systems. And I'm not sure if they're a direct competitor. I don't know enough to say, but you can see the difference between a Fix and a Lennox,
Yeah,
assuming that
or if I mean this is so yeah, so I think I saw
Caterpillar, yeah,
on
yeah,
on our billion-dollar watch list today, but it must have fallen off. But it
yeah,
already had the retest of the 200 day, and it's now forming higher lows and higher, trying to make higher highs. So these are all, this is where rotations are happening, whether it's local or foreign HVAC companies.
yep. Okay, excellent. Thank you, Alex.
Mike, let's talk about something I think it's worthy of a conversation. Gold. You want to talk about that?
Yes, yes. We had a member ask about gold, and if I could paraphrase the question, um, some people look at gold as a perma part of their portfolio that they're going to hold no matter what, as a hedge or long term, whatever. And some obviously will ride the trends like we have. And the question was, now that it's clearly living below the 200-day moving average, a kind of commonly accepted level, is it a time to kind of just cut and run, whether you have large gains or not? So that's kind of the gist of it, Scott. What's your assessment at this point?
Yeah, so let's go back to the daily chart of gold. So it's had a mega run since 2023, and it was at $36 on IAU, and it went to 105. And it had a bit of a blow off top, and it's been coming down. So our trend roadmap strategy exits here, where my mouse is at 95-ish. Again, you can look at the trade log. I don't remember exactly what the price was. Our longer term strategy in our advisory uses longer term signals, so that was an exit. Um, and if someone has short-term capital gains versus long-term capital gains, we can be a little bit more creative in an advisory scenario. But it wouldn't shock me if,
That's the only thing we do permanently is manage risk. And so gold in our two strategies, I think Scott mentioned it, trend roadmap, shorter term strategy. We were out a couple of months ago. And if you were following the long-term signal of the trend roadmap, that was, I think, a close on June 10, as memory serves, a break. And then, ironically, our cruise control strategy, which is meant to be a long-term, more tax-sensitive strategy in our advisory, that got the close signal on the 9th. So you had both strategies kind of coinciding with the long-term trends falling off. So basically, manage your risk and get out.
yeah. Don't get me wrong, this isn't easy. That's why having a process is so important. If you're
Uh,
doing it, yeah, because what you're probably doing is you're looking at enormous gains, and it's hard. So even if you're incrementally able to move in and out in portions, the question is like even Bitcoin, like like let's just pull up Bitcoin. Um, so Bitcoin has been obnoxious since November of last year, and you still have negative momentum today. So for all these mm, Bitcoin Buffett buy at the bottom, like I don't think it's time. The market's not showing us that. I actually think that it could get potentially way worse. So you rallied into some support. That was the worst trend line, support line ever. But why couldn't you go all the way down to whatever that is, like 50,000 on Bitcoin? You could go way lower. And then maybe finally you get your full washout. So, and then the big thing is the opportunity cost of all that time where your money really wasn't working. It was just kind of gliding slowly down in a death spiral. So we live in a world, at least for most of us, of commission-free trading. And then there's taxes. So that's something that you have to work through personally with your CPA. But managing risk is way more fun paying taxes on gains than watching gains slip away to nothing.
Yeah, managing risk and being okay with being wrong. We've talked about this. We've talked about training psychology. We focused in on it, I think, a few episodes ago. But yeah, it's trading, investing teaches you to be comfortable with being wrong, because as traders, we're typically wrong as much as we're right, based on the depending on the strategy. But yeah, if you'd managed risk on Bitcoin and on a break you got out and all of a sudden it flipped around and started working its way back up, you buy it back. You just say, "Oh, I'm wrong," dust it off your shoulder, next. And if your buy signal is there, you buy it back.
You
But
know,
it's
what's
better to do that than staying wrong and having this kind of damage.
it's ironic? At the number one item on our watch list based on our system,
Is
which could,
shorting Bitcoin.
yeah, and it's on an overheat, so it'll fall off when we do an update later today.
Yeah.
Um, Home builders. So interest rates down, bonds up. Who benefits from um, you need to build more homes? Who could benefit from this? It's going to be things like the home builders. And looks like it's powering higher yesterday on that news, giving up markets under pressure today. But so for me, what I see is home builders. I'm just looking at the watch list until we re-update it. Insurance stocks, that's a kind of a tough give back. Deere, we own that in Fastlane, correct?
I believe so, yes.
Yeah, we own this in Trend Roadmap, which is regional banks making new recent highs. Um, for all of you who home building parts, these
Yeah, we have that
suppliers.
same one. Yep.
All right, what else we got?
Okay, so a few questions came in, comments. So Jim asked, doesn't gold move inversely with the dollar? Right in your wheelhouse.
Sometimes, sometimes it doesn't.
Yep.
Um, so here's your dollar, which is not great. If the dollar keeps strengthening, that's not good. You've been on overheat for a while. For equities, you'd want to see it pull back. Same story typically for gold and gold miners. And again, I think at some point you're going to have some sort of bounce up into support.
Hey, do me a favor. Just I don't know if this will show anything of value, but go back to gold and then throw up the comparison chart of the dollar. It may not show anything, but I was just curious.
Hard to see because one is so volatile, or one is
Yeah,
significantly less volatile than the other. So
yeah.
when the dollar's falling, gold is ripping, and then the dollar found its low, and then it's been slowly making higher highs and higher lows.
Yep, there you go. Okay, and then Alex says Taurus being flushed, gotta love hate. I don't get that, Alex. So if you want to jump in and either I don't get that comment. My apologies, but if you want to kind of clarify that one,
This is gold tourist, or who's the tourist?
I don't know. I don't know. I'm sure knowing you, Alex, it's a pertinent comment, but I don't want to ignore it, but I don't get it. So please jump on if you are still on. All right, Jim then says MSTR and BMNR were supposedly great Bitcoin plays. Yeah, they don't look so good anymore. Absolutely.
Yeah, if you take your corporate cash and you buy Bitcoin and you raise money for bonds and you buy more Bitcoin and Bitcoin falls, you're now levered Bitcoin. So that's not pleasant.
Yeah. And then if you could throw up the B, I'm sure we're going to see the same thing, BMNR, BMNR.
And I think these guys take Ethereum
Oof.
as their treasury versus the US dollar.
Ouch. Yeah,
Uh,
throw up Seth, SETH. That's the inverse of Ethereum. And look at that. Yeah. Like look at that. Very sloppy, albeit, but look at that cup. Look at the handle. There you go.
and I would always position size smaller on shorting just because you can be real wrong real quick.
Absolutely. Yep. Great comment. All right, excellent. I think that does it.
Enjoy the rest of your week. Have a great day. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.